The Money Show. Personal finance.
Warren Ingram, Executive Director at Galileo Capital, a personal financial advisor, managing income from investments during retirement. We talk a lot about how to make sure that you save enough and invest enough and get the best possible returns over the longest possible time. Start early, delay cashing in your investments until the last possible moment. Work as hard as you can for as long as you can, because you need to have as much capital at the moment you stop working as you possibly can have. Then comes the problem as to how do you ensure that that capital lasts you for as long as you need it to last you?
And I think it becomes almost like a game of chicken if you think about the last 2 or 3 years where the stock market hasn't really gone anywhere, except for I guess the last month and a half where it's done really nicely. But before then, if you'd retired 3 years ago, you've looked at your portfolio, which if it's been well structured, has been quite well invested in the stock market, and you've probably generated 4 or 5% a year for the last 3 years. And if you've been drawing what I would have been telling you to draw on your retirement, which would have been about 4 or 5% from the value of your retirement capital, then what's happened is actually you've gone backwards, because inflation is running at 6, or I know it's gone down right now, but let's just say it's gone at 6% a year as an average.
On average, South African inflation over the last 40 years is 6%.
6%.
If you're lucky, actually.
So the buying power of your money has gone backwards by 6% a year for the last 3 years. And it becomes really frightening now, because that means, you're down more than 18, you're probably down 20% in terms of buying power. So for retirees, it's a very difficult time. And those that have been retired for quite some time might have been through some big market ups and downs before this. So they're old hands at this, probably okay. But it's the people that have been retired, let's say, for the last decade, and especially the last 3 years, that I think are in great danger of making some pretty bad mistakes. And unfortunately, there's always sort of the scaremongers and the people creating hype, I think, in the wrong direction, which you've just got to ignore very often.
Magnus Haystack has got a friend, he's a financial advisor, as you know, has got a friend who runs a spa in Mossel Bay or Knysna or George or somewhere where lots of people like to go and retire, to the coastal life. And this guy at the spa says he sees these newly retired couples, they arrive in their shiny new car that they bought for retirement, and they come into the spa holding hands, wearing trendy clothes, and they buy nice cheeses and nice luxury items. And 10 years later, that same couple is driving the same car, which has now got rust marks on it. And unfortunately, they're not buying the same quality stuff. They're being far more parsimonious with their purchases. And they've invariably, many people unfortunately fall on hard times because they forget to factor in the evil of inflation, how it destroys the value of money more quickly than you could possibly imagine.
And I think so as soon as you're in that position, you're tempted to make a change, make a decision, do something, because this can't carry on like this. My capital's going to get eroded, etc., etc. And that impulse is completely normal, completely human, but unfortunately very bad for helping you to make smart investment decisions. So to me, you've got to be really careful now. If you're in that position, you've got to think about this and say, well, okay, so markets move in these big cycles, and moving into something like a guaranteed annuity, because I bet you, I've seen some already, but I'm really sure the product providers are soon going to be advertising, guaranteed annuities where you can get a fixed amount of income guaranteed.
And it's so attractive because it gives you peace of mind.
Yeah. And that's great. The problem is that if you look at what you're actually getting as an income stream compared to the value of your capital, I don't think it's very exciting. And then you're going to get really low inflation-related increases on your capital. So what's happened is you've gone sideways in terms of pre-inflation numbers for a couple of years, and now you lock in that value because you sign up a contract, which is actually what you're doing with an insurance company, and they take your money, they give you a fixed income stream for the rest of your life that you hope will keep pace with inflation.
You're hoping, and also, if you live for 1 year and you die, then the money goes to the insurance company. If you then manage to get one over the insurance company and live for 25 years in retirement, possibly you score. But by year 25, have you kept up with inflation? Are you maintaining a lifestyle that you thought you would by taking out this guarantee?
Yeah, so they have evolved them slightly, over time. So nowadays, what they'll do is a large portion of the capital would go from your. Let's just say it was you passing away, it would go to your wife, and then when she passed away, it would end.
Yeah.
But and if we see them, the increases are okay. They're not fantastic. And if we see a period of time where your inflation rate, your personal inflation rate, goes up beyond the 6%, beyond the CPI basket, which most retirees will tell you that's exactly what happens to them.
Electricity. It's the administered costs, the things of which you have no control. You need medical aid. You need electricity. You need to pay your rates and taxes. And invariably, these are the costs that actually are rising, often close to or in double digits.
Yeah, I think I think if you look at medical inflation as a good one, for example, the cost of medical aid, to me it averages closer to 10 or 11% escalations over long periods of time. So you've got to be really careful. And I think my message then is look at your portfolio of investments and then decide what happens if you move to a guaranteed investment now. In other words, you go to a guaranteed annuity, or you lock in your capital into something that just gives you a guaranteed return, and then the JSE continues what it started in July. In other words, it gives you another month or two where you get 7 or 8% in 1 month. How much better off would you have been
had you locked it in then? But that becomes a question of market timing. What's been getting a lot of bad press, and I don't want to rush it, but living annuities. Now, what is a living annuity? It's like a guaranteed annuity, except it's not guaranteed.
No, it's not.
It's a monthly payment of money based on your assets.
You take your capital from your retirement fund. You retire from there. You take a portion of the capital out at your discretion up to a certain limit, and the rest you buy an annuity. In other words, you say, I'm going to choose at my choice between 2.5% a year up to 17.5% of that value. I'm going to draw out as an income on an annual basis. That's your choice, and you'll be given that choice on the anniversary of when you retired every single year. And then you're given quite a wide range of choice as to what you want to do with the investments within that living annuity. So you could, for example, go 100% cash, and there's an anomaly in the retirement laws where you're actually allowed to go 100% in shares if you were, I hesitate to say crazy enough, but you could do that with a living annuity.
You could continue to take risk then in your retirement with these assets.
Yeah.
You could continue to say, I believe there's a good bull market underway here. I'm going to take a chance this year, and I'm going to put all of my retirement assets into the share market and go to church twice as often, because I've got time now.
Yeah, and I guess, no surprise, I'm going to really strongly advocate against that. So I mean, I think, having a good spread of assets, cash, bonds, property and shares is a great idea. And what's happening at the moment is a lot of sort of fear-mongering around living annuities because portfolios have been flat for the last couple of years, that suddenly these are now terrible investments, and we're going to see mass poverty in retirement because people are in these products, retired people. And I think that's not true. I think the point is, if you can continue to make smart and rational decisions, these are great products because you control what's going on inside there.
Why is the Financial Planning Institute, I think it's the FPI, getting a little bit antsy about these things?
No, it's not the FPI. It's a new association.
Okay, I beg your pardon.
And I can't remember their name. And in all honesty, if I did, I wouldn't want to talk about them. I think that they're seeing a couple of examples where bad advisors, in my view, frankly, have given bad advice to people at retirement, and now they're too scared to go back and say, look, I really made a mistake there. And let's correct the mistakes within your living annuity. Now what they want to do is say, living annuities are bad, let's sell you guaranteed products. We get nice upfront income, and we don't have to talk to you again in the next difficult market. Terrible. I think it's the worst kind of way of promoting advice in a situation like this. I think if people are correctly advised, these are really powerful.
Okay. Good. I'm going to leave it there.
Get off my soapbox.
No, fine, but one last question for you. Sheldon, he says, I love your show. Well, Sheldon, that's why I'm asking your question. I have a question. My RA is with Liberty, and my current financial advisor is a Liberty agent. I'm considering moving services to another financial advisor who is not a Liberty agent. Will I be able to move control of my RA to this new advisor without necessarily taking it out of Liberty?
It's one of those situations that it will depend. If it's a very old-fashioned RA, you might find that it's predetermined, everything's fixed already. There's actually no change to be made, but you can change the servicing advisor or servicing broker. But if it's a more modern one where you've got underlying unit trust inside there, although it might be a Liberty RA, then certainly an advisor who's got a contract with Liberty, although they're not a Liberty agent, they can help you and take over. So you just have to check, but very often you can.
There we go. Warren Ingram from Galileo Cap.